we're actually in one of the more interesting times, and we're kind of moving out of it. But for a lot of the past 6 to 12 months, we've been in an environment that has had an inverted yield curve. And you guys have probably heard that term. Some of you are more familiar than others. What that means is the short-term interest rates are higher than the long-term interest rates. And why is that? There's a variety of reasons, which is probably its own class unto itself, based on how the market prices it. But basically, in the future, lenders expect the cost of capital to be lower, is probably the simplest way to put it. So why is that factor important? So I'm in the market now getting a construction loan, and it's actually cheaper for me to get a fixed rate construction loan. It's upside down. It's almost never cheaper, but it's actually cheaper for me to get a fixed rate construction loan than to get a floating rate construction loan by about 100 basis points. So it's kind of a funny backwards world we're in, and the yield curve is fairly rarely inverted, and usually indicates not good things to come in the market. So it's a very unique time in that respect. And so when you're looking at these indices, the long-term indices are very often treasury based. So you have 2, 5, 10-year, whatever it may be. And so those are what you'd look to with their relative spreads, and compare that to the what's often the SOFR rate and its relative spread. And that's kind of the comparison of short versus long.